Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday market recap. Hope everybody had a very good day in the markets today and a good week of trading as well. And in today's markets, guys, well, the bulls continue on with a very nice bounce continuation. In terms of our price action, we are not looking too bad at all. A nice engulfing move on the SPY and a very nice engulfing move as well on the QQQs. And this is a byproduct, guys, of removing uncertainty catalysts from the markets. Just a week ago, we had covered the uncertainty catalysts on the horizon for the markets as a whole, and there were many catalysts to be had, and we went over the pros, we went over the cons, and all the volatility catalysts down below, and now we have removed quite a number of them. We removed in the last 2 weeks a jobs concern over the jobs reports. Both the JOLTS jobs openings and the non-farm payrolls were good. Number 2, CPI and PPI, both reports came in pretty decent, all things considered. We also got very decent retail sales for the month of December, which showed that the consumer remains on strong footing. And also we did have bank earnings that pointed to, once again, a strong consumer, positive net interest income for the banks, and all the banks being well capitalized in the event of any foreseeable future credit events. So all in all, markets are not looking too bad. We've removed a lot of the uncertainty from the market, and as a result, we are now getting some very bullish momentum follow through to the upside. But the job is not done. We still need to set the daily higher lows because we know the bounces can be nice, but until you actually confirm the actual trend change, all it is a very nice bounce. So in today's video, guys, we're going to take a look at a few things together, of course. Number 1, we're going to be going over 2 earnings reports that I have prepared for you guys. That is going to be Bank of America and Morgan Stanley, wrapping up our bank earnings for the week. Thereafter, we'll take a look at our technical analysis rundown in terms of our major market sectors. Thereafter, take a look at our big tech names and see whether or not it's a good opportunity to be buying the dip, either in sector-specific names or perhaps in big tech names as a whole. And then lastly, of course, we're going to look at my portfolio for the trades made this week and a quick portfolio review, but I'll also be giving you some of the swing trade setups that I am most closely paying attention to in this current market environment. So all that being said, guys, should be a very interesting video. Let's jump right into the action. So the SPY up about 1%, the QQQ's up 1.69, and I tell you guys, always pay attention to the rotation. And as a whole, it was a very broad market day of participation, aka the rotation was very good. Take a look at the heat map, big tech and semiconductors having a very good day of follow through today. Not much in terms of news today, guys, just bullish momentum follow through as a whole. I mean, we did get some form of small little news events, which you can possibly attribute to having more bullishness, but largely it's just bullish continuation from CPI and from those bank earnings. Today we got housing permits in terms of building permits, so new housing starts came in better than expectation, and also industrial production, a big one, 0.9% versus the 0.3% consensus. So it shows that the economy is still moving on strong. However, you can't rely too much on these numbers, guys, because they do fluctuate a lot from month to month, but it did add to somewhat of the bullish sentiment for today. I'll remind you guys that in terms of next week's anticipation, well, next week is a very big week. Monday, we have the holiday, of course, for Martin Luther King Jr. Day, which is always the 3rd Monday in the month of January, so the markets will be closed. But of course, that is the same day as the Trump inauguration session, so that will probably be a very interesting thing to watch. And you guys probably know Trump by now. Come Tuesday morning, he will probably have signed 5,000 executive orders. So next week, we will have a ton of new information as pertaining to his policies surrounding tariffs, potential deportation, and a number of other different things that may impact the economy. So next week could be volatile, but it's going to be the Trump factor. Not because we have any other major macro news releases. The only one on the table largely is the Friday session where we get global manufacturing PMI. Thereafter, guys, we have a very big week of earnings too. Take a look at this, guys. Very huge week of earnings as a whole. Netflix on the Tuesday session, but you can see so many large companies all across the board from many different sectors. There will be opportunities, in my opinion, all over the place. We are going to take a close look at a few of those earnings next week together, of course, but Netflix, arguably the biggest one of them all. Charles Schwab pretty much wrapping up the big bank earnings as a whole on the Tuesday morning session as well. So all in all, guys, very good day, but next week we could have a lot more volatility. So the bounce is nice, broad market sector bounce, only healthcare getting left behind a little bit because of some drug-related issues with Eli Lilly, Novo Nordisk, and a couple other pharmaceutical companies. But other than that, the bottom half of the market participating very well because yields once again today were down. So the bottom half of the market participating in the rally, value names alike too. The one-day relative, you will see that every major sector in the market except for healthcare was participating to the upside, led by consumer cyclical and technology. On the 1 week relative, everything except for healthcare, once again, is in the green. Healthcare, we were saying this, guys, it was going to be one of the bumpiest trades leading into Trump's presidency, and so far we have not been wrong. I do expect that volatility to possibly continue in the healthcare sector for at least maybe the next 2 to 3 weeks as we get some formal policies on what he plans to reform, if anything, in terms of Medicare and Medicaid. On the 1 month performance, you can see the damage that Jerome Powell did. We are not at the all-time highs on the SPY just yet, and not all sectors have been participating. The best of the bunch, surprisingly, energy and utilities, followed very closely by financials, but everything else still on a 1 month relative, guys. It still doesn't look like it did back in November, did it, right? A lot of the market still being left behind. And a lot of tech and large consumer defensives names still underperforming in the last 1 month of trade. So before we get into more technical analysis, guys, let us dive very quickly into some Bank of America and Morgan Stanley earnings, just to do a quick little health check on what is their stance on the consumer. We heard earlier this week from JP Morgan and a few others, Citigroup and Wells Fargo, and they said that the consumer is on good footing and that the bank is well capitalized and that we're not seeing an increase in default, nor in terms of commercial debt, nor in terms of consumer debt, just the same. So Bank of America is one of the largest banks in the United States. So it's very curious to see what they have to say in terms of the health of the consumer and the, the health of consumer credit as a whole and commercial credit too, because it does matter. They crushed it, guys. Similar to the rest of everybody, of course, they absolutely destroyed it. Earnings beat by about 6.6% and a revenue beat by about 0.73. But it was all going to be a story about the guidance, and the guidance did not disappoint. Bank of America profit beats expectations. Let me start again. Bank of America profit beats expectations on trading boost, sees higher 2025 net interest income. That is the headline we were looking for here, guys. Most of the banks have guided to the fact that they do expect net interest income to be higher in 2025, a byproduct of the few rate cuts that we've already had, of course. Moving on into the article. The lender predicted it would earn more net interest income in 2025. The earnings from Bank of America mirrored the rivals of Wall Street, including JP Morgan, Goldman Sachs, Wells Fargo, Citigroup, whose results were buoyed by stronger equity markets and investment banking. So not only are they making more money in net interest income, but the big money is finally coming to the table, guys. More deals, more mergers and acquisitions, more IPO processes in place as well. So that is what you want to see when you have broad market participation in the banks, not only from the consumer side, investing more of their money, but also on the commercial and institutional side of the bank, whereby you have more people wanting to do large deals, which I will remind you was not the case in 2022, nor even in 2023, and barely in 2024. Moving on further, every source of revenue increased, and we saw better than industry growth in deposits and loans, said the CEO Brian Moynihan. The broad momentum sets up 2025 very well. Net income rose to 6.7 billion, guys, compared to 3.1 billion a year earlier. Now, this is a slightly low number because I'll remind you, the first quarter of last year, all of the major banks had to pay a heavy fee in terms of the banking crisis that happened in March of 2023 to kind of come in and kind of backstop some of the pain, right? That was one of the Fed's obligations from these big banks, was to kind of take a little bit of that burden on. In other words, right? I'm giving this a very brief rundown, but essentially that's exactly what happened. Now moving on further, but that is a double, technically speaking, from the year over quarter. Bank of America's sales and trading revenue rose 10%, and the division notched records for the fourth quarter and full year. Fixed income revenue rose 13% because of improving performance in macro products and continued strength in credit, while equities climbed 6%, fueled by more client activity. That's what you want to see. Obviously, the markets were very bullish, so it kind of goes hand in hand, though. Bank of America's Wealth and Investment Management division also benefited from surging equities, attracting more client money. Its revenue climbed 15%, while client balances jumped 12%. Wall Street profits rebounded last year as mergers and acquisitions recovered from a decade low in deal volumes in 2023. So now we're starting to see those deals come back into place. And I'll let you know, guys, The big money only starts doing deals when they know that the economic outlook, at least for the next 2, 3, 4 years, should be very good. So if big money's coming to play, it lets you know that they as well are confident in the direction of the economy. Moving on further, bankers anticipate a stronger 2025 for deal making, helped by Trump's vow to implement pro-business policies. Investment banking fees rose 49% at JPM, 24% at Goldman Sachs, 59% at Wells Fargo, and 35% at Citigroup as well. Bank of America's investment banking revenue was up 26%. Moving on further, net interest income. This is where you got to pay attention. Their net interest income rose 3%, very good. That marks the first time Bank of America has posted year-over-year net NII growth since the third quarter of 2023. So it's been some time. We're seeing a rounding of the corner in net interest income, and it's also, additionally, well, not additionally, but entirely almost a byproduct of the rate cuts the Fed has done so far. We believe at this point we can continue this trajectory. The economy is performing well, our asset quality is healthy, and the consumers are still spending. A steeper yield curve is also positive for banks as they can borrow money at lower short-term rates and lend at higher long-term rates, bolstering their interest income. This is true, guys, right? Think of the Federal Reserve overnight rate right now, which is roughly around 4.5, 4.75%. The banks can borrow at that and then lend you a mortgage at 7%. So they always pocket the spread, right? But when these short-term rates, when the yield curve gets a little bit steeper, they can make even more money on that spread. So it's just very logical for them. Now, if you don't believe that report by Thomson Reuters, let's take a look at Bank of America's actual data from their release. You can see here deposits increased to 2% year over year, very strong balance sheet, and their capital requirements at 11.9% are well above the regulatory minimum. I'll remind you, the regulatory minimum is roughly 6%. So double the required regulatory minimum. This is just how much risk they're allowed to take on in relation to the cash and cash equivalents that they have on the balance sheet. There's an equity component there as well. But all you need to know, guys, is this was put into place after 2008, the great financial crisis, to make sure that the banks, in terms of cash equivalents, and readily marketable securities and common equity as well, they want to be sure that they can cover a decent portion of the deposits if ever there is a flight of capital away from the bank. Tons of people coming to the bank, withdrawing their money at the same time. 2 times the requirement, and we saw it from JP Morgan yesterday. Theirs was closer to 15%. Also, 2.5 times the required regulatory minimum. Very robust liquidity as well for this bank. So definitely, are we going to have another 2008, guys? Not even close. And I've been saying this since I started the channel pretty much. Not even close, guys. The banks are way, way, way too well capitalized this time. And we can take a look at some of the highlights as well. 1.1 million checking accounts, very good. 4 million new credit cards, very good. Record consumer investment assets up 22%. 3.9 million accounts, that's up 3% as well. Moving on further though, because you guys want to see one thing, and I can't blame you, right? Net charge-offs for the bank, that was up ever so slightly to 1.5 from 1.2 in the last year period, but they did not build any further reserves for more net charge-offs. What does this mean, guys? Well, it means that the bank is very bullish on the consumer and bullish on the outlook of the economy and bullish on consumers keeping their jobs. If not, they would be adding to these reserve builds, which we have not seen in the last 2 quarters, nor from them, not much from Wells Fargo and Citigroup either, and definitely not from JP Morgan. We looked at that yesterday in the video. Moving on further, guys, another thing that is very notable to pay attention to, right, is the asset quality. This once again has to do with the, asset quality pretty much of the consumer and commercial institutions that do banking with Bank of America. And as you can see, the net charge-off for the entire institution right now, the net charge-off rate is going down. You can see the amount of charge-offs are going down, and the percentage is also going down too. Provision for credit losses across the institution is also flattening out and coming down. The only time they've increased it so far is because they've had more clients, but now they are bringing that down as well. Very, very solid here, guys. Extremely solid. Credit card loss rate of 3.79 we saw from JP Morgan yesterday. It was about 3.2 at JP Morgan, which is arguably around the historical averages of the bank. So we're not seeing any crazy, any crazy ballooning in net charge-offs, consumers just defaulting on their obligations one after the other, creating kind of a spiral effect. We're just not seeing it yet, guys. Trust me, I'll tell you when we do see it. But as of right now, we're just not seeing it. So that whole, total consumer credit outstanding in the $1 trillion range, Well, yeah, of course, because we have more consumers that have more credit cards right now. But in terms of percentage of assets at the bank that represents, it's not going up that much higher, guys. It just goes to show, right? Now we move on further. Consumer net charge-offs, that slight little uptick here to about 0.96%. Not the worst. It's roughly the same as it's been, the last few quarters, but it is worth noting that it is on a slight uptick right there. Commercial net charge-offs comes to counterbalance that, as we do have a net decrease in commercial real estate charge-offs right there, which is very good. And they said on their earnings call as well that they do not think that the commercial real estate holdings that they have are going to be problematic for the bank, especially not when rates are coming down as they are. So that is pretty much everything for Bank of America, guys. Spent a little bit more time on it because it's important, right? We need to get a sense and a gauge of where is the consumer standing. And if you don't trust the data from CPI, if you don't trust the jobs data, if you don't trust any of this macro data, well, you can actually look at banks' earnings, which are all audited by other distinct corporations. And if you don't believe the bank earnings as well, guys, well, I don't know what I can do for you at that point. You know what I mean? So moving on further, in terms of the Bank of America earnings, in terms of their valuation, revenue growth of 5.1% per year, that's decent. It's a bank, so you're not expecting double-digit growth here. EPS at 10.5% per year, that's very good. Gives them a forward PEG ratio of about, forward PE of about 12.33, which is arguably historical averages for Bank of America. And the forward PEG ratio is about a 1.17. Now, you're not really supposed to use the PEG ratio for banks. I do it anyways, but usually for banks, guys, the valuation is a little bit different. It's not price to sales. It's not price to earnings growth. It's more price to tangible book and a whole bunch of enterprise value as well, because so much emphasis is put on the balance sheet and the health of the balance sheet. But to keep things simple today, all you need to understand is Bank of America is roughly trading in line with its historical averages. It's not cheap. It's not expensive. It's just, that's what it is. It's at its historical averages, right? Analyst price targets are a little bit higher, the average point being about $52. All in all, though, guys, expanding EPS, expanding revenue over the foreseeable future, consumer remains healthy. So this stock is quite decent right now, also benefiting from a large weekly uptrend, right? Ever since the lows of the month of August, and right now on a little upswing as well. I'm always interested in playing the banks sometimes if they give me a good enough entry, but it has to be coming down into a support range. So, we were there last week, but if ever we can revisit $44, $42, I might be interested in writing some short puts just for some weekly exposure. I don't really hold any banks in my long-term portfolio. I don't think there's anything wrong with them. They just don't grow fast enough. Even if you measure with total return by adjusting with the dividends, they just don't grow fast enough for me. However, if I was maybe closer to retirement, then I would be considering plays like Bank of America, JP Morgan. I think for the banks, you have to go with kind of the biggest and strongest banks out there. And definitely in this case, it is Bank of America and JP Morgan. No major red flags to speak of right now, but all the way up here, guys, as I said, right, you're not getting a tremendous discount, but do I say any problem with valuation? No, not really. These should move up as the economy keeps moving up and as the markets keep moving up as well. It's just that the performance, you're probably not going to be able to beat, the NVIDIAs and the Microsofts of this world on an annualized basis, but at least you get paid a decent little dividend, and it is more of a defensive play, of course, right? So moving on further, guys, in terms of the analysis for Morgan Stanley, let's do number 2, and then we're done. I'm going to spend a lot less time on this one, guys. I didn't really do any valuation metrics. My mistake. I forgot them on Goldman Sachs as well, but let's just get through them. As a matter of fact, I'll tell you right now, guys, even though they did beat, it's a little bit expensive up here. So let's move on. 30% beat on EPS, fantastic, and revenue beat by about 8%. And when we look at Goldman Sachs and Morgan Stanley, we're just interested in knowing how is the deal flow? Are more of the big players in the market coming to the table for mergers, acquisitions, leveraged buyouts, IPOs, all of that stuff, right? Are they coming to the table with money to play? And as I said, the big money only comes to the table when they know that the outlook for the next 3-4 years is going to be decent. You're not going to deploy $5, $10, $15, $20 billion if you are possibly going into a recession, or if the probabilities of going into a recession are anything other than quite low. So it's nice to see the deal flow is coming back to the table. Let's have a quick little glimpse into the Morgan Stanley article. Tops estimates on strong equities and fixed income trading revenue. No secret there. Everybody's pretty much done that this quarter. The bank said quarterly profit more than doubled the $3.71 billion from a year earlier when it had a pair of regulatory charges as well. That's what I was saying with Bank of America. Revenue rose 26% as results in all of the bank's major businesses improved. It was the firm's equity trading business that shone brightest in the quarter, producing a 51% jump in revenue. Morgan Stanley cited increased client activity and strength in its prime brokerage business that caters to hedge funds. Notable there. Investors Investment banking revenue rose 25% on rising advisory and equity capital markets results, and the wealth management division saw a revenue rise of 13%, topping the estimates as well, so beating the estimates essentially almost all across the board. While the bank stocks have been supported by enthusiasm over expectations for rising deal activity, it was actually the trading side that helped Morgan Stanley and rival Goldman Sachs more in the quarter. However, the rising deal activity definitely did help as well. So that's pretty much it for Morgan Stanley, guys. Nothing fancy to see here. It's the same thing across the board for all the banks. Record profits, a decent amount of deal flows, at least a record since the lows of 2023. And all in all, guys, a very decent price appreciation as well on these stocks. So as a whole, guys, Morgan Stanley remains slightly elevated. Very tough for me to buy at 137 after the stock has literally just moved up 12% in 4 days worth of time. And the valuation right now on a forward basis is sitting roughly around 15. It's not cheap, it's not expensive, but in the midst of a massive breakout, and this extended from the 12 EMA, I'm not the biggest fan of buying these. Usually I like to buy these when they have consolidations or maybe even something like a breakout or retest of the support and then run. But all the way up here, guys, I kind of have to pass, and that's the case for Goldman Sachs as well. Goldman Sachs largely having the same price activity right here. I mean, if you have a long enough time horizon and you're willing to take the gamble on them, it's fine, but you get caught in a period where you buy it too high, then the markets kind of do nothing for like 5-6 years in financials, which can happen even though they improve fundamentals. It's not going to be a fun time, right? I don't think that's going to be the case, at least maybe not for the next 6 to 12 months. They could have some rally, but I just don't see the best risk to reward trades in the Morgan Stanley and JP Morgan, in the Morgan Stanley and Goldman Sachs trades. JP Morgan and Bank of America, not too bad, but still not excessively discounted, right? That pretty much wraps it up for our bank earnings, guys. Hopefully you enjoyed that. Now let's get into some of the good stuff, which will be a technical analysis rundown on all our major indexes. So getting into the SPY, guys. Now, in terms of the SPY, the bounce, as I said in the intro, the bounce is nice, but it is not the end all be all. We had one bounce here, one bounce there, one bounce there, but they all do not mean very much unless we can recapture the daily uptrends. That being said, we're coming into resistance 602 down to about 596 below us. Or sorry, above us right now, and below us, we do have a suite of moving averages here, a little bit of a gap fill after the CPI, and below support around 584 down to 576. The good thing now this time, this is the best bounce we've seen in the last 3 attempts. It is a full engulfing move, and now the bulls have maximum space above 575, the fear lows, to create that higher low for the possible further trend change. And until they do this trend change, guys, we cannot say that weekly consolidation is officially finished, because we could very easily just be sent back down into a little bit of turmoil. That being said, weekly downtrends are still in play, even despite this bounce right here. Not looking too bad, reacting nicely from the 26 EMA on the weekly, but all in all, guys, need to get that final confirmation. So if we do dip early next week because of some Trump volatility or whatsoever, I will be looking to buy these dips in my favorite names. If the SPY and the QQQ come down, it'll open up some decently attractive levels on a lot of your favorite stocks out there, and it could be one of the final opportunities to possibly buy any or all dips that you want to position for some of the tech, not only tech, but all of the earnings coming up in the next 3 weeks worth of time. So that is everything for the SPY. In terms of the QQQ, well, you know, I didn't do this on the I didn't leave the downtrending channel here, but of course we have a break of the channel, but I want you guys not so much to focus on trend lines. I want you always to focus on price action, because trend lines are fun, and yes, they are respected more times than not. However, you have to focus on the higher high, higher low, higher high time patterns in terms of control, right? That is really what's going to save you in the long term. Now, in terms of the QQQs, same concept, right? 1, 2, 3 bounces. A bounce is nice, but it is nothing without a confirmed daily uptrend. That being said, we did retest a lower end of which previously was resistance. Now we're above it. Now we've closed a weekly candle above it, so I can finally turn this box green again. So hooray! Good thing for the bulls. We've now turned this one green. Over below support now stays put at 515 down to about 510. So in the event we have to retest this area, because we will be looking for a daily higher low. Anything above 500, just going to be looking for that daily higher low for possible trend change back to the bulls. Same thing on the weekly as the SPY, guys. As long as we cannot confirm the daily uptrend, I cannot say that your weekly consolidation phase is over, because next week we just get a nice red candle back down there and we'll just be right down here, right? Need the bulls to change the daily trend change. and then only then we can start talking about some possible weekly trend recaptures as well. But all in all, not looking too bad. The QQQs as well rejecting from the lower end of support and the 26 EMA, which was these guys down here, 500 down to about 495. So all in all, not that bad, guys, and a very nice from bottom to top, almost 5% pop. Moving into financials right now. Well, financials, of course, continuing off of the bullishness of those banking earnings. We'll get to hear from a few more next week. All in all, though, very nice engulfing move. Eventually, guys, because we are starting to get a little bit overbought here on the hourly time frame, we will probably lose the hourly time frame eventually, right? We will start getting the hourly downtrend being set, and that's when you'll know that the daily consolidation is underway. Good thing for them, they have a ton of space, anything above 47, looking for a daily higher low for possible trend change back to the bulls, because we know we've been stuck in this daily downtrend pattern for a very long time at this point, since the early stages of the month of December. And below support right now is going to be Confluence. I mean, I can put a little box here. It's not a very strong box, but it is an area of contention, meaning down here about 49 down to about 48.50. Confluence of all the daily moving averages, confluence of previous resistance, which should be acting as new support. So if they do choose to come down here and fill the CPI gap, well, in that case, guys, just be looking for a higher low for a possible daily trend change. Now, the weekly on this one is looking quite good, but once again, even though it appears that they have everything in the bag, guys, need that daily trend change for me to confidently say, okay, weekly consolidation is finished, and we may be looking to just proceed into a new weekly uptrend because we lost it. This was the first weekly downtrend, reacting nicely from the 26 EMA. So all in all, I like these moves on the weekly, guys. SPY engulfing move on the weekly, QQQ, arguably engulfing move. Financials, definitely an engulfing move, but you need to prove it to us to reset that. So I might be interested, guys, if we do have that pullback, in looking at some of my favorite names. And some of those guys are some of the ones that I closed this week right before the volatility. Berkshire, looking for that same setup, possibly looking maybe for new all-time highs in sight, February and March. Moody's Corporation as well, not too bad, coming out of the big zone of support. Could be looking for more accumulation, but eventually a pop. Moody's should be doing quite good over the course of this year. Extremely, extremely solid company. And even a company like MasterCard, right? They had a dip, touch the 26 EMA. If we do get a slight retest here, going for the daily trend change, I may be looking to make an attempt at the higher lows, potentially at the higher lows, and go for that daily trend change as a whole, right? So not too bad in financials. There is some opportunities if you know where to look, but have to be a little bit still conservative with our position sizing because we know that the volatility can continue at least over the next 2-3 weeks during the earnings cycle, and especially leading into January 29th, which is the Jerome Powell possible Federal Reserve pause and further commentary like he did in December, right? So it's all going to be about that commentary. That's what really unraveled us in the first place in December. Moving on to healthcare right now. Healthcare a little bit weak today, but that's no secret. Healthcare has been worth a week for the last arguably 5 months at this point. Weekly downtrend has been clear as day. The bounce was nice, but as I said, guys, 50% bounce size does not guarantee anything on the weekly. If anything, you still leave the bears a chance to roll this one over back to the lows. Now, if the overall market continues on a bullish lean, well, I don't believe we're going to retest the lows, but we know healthcare is going to be front and center in the Trump spotlight on two fronts. Number one, because you know that he wants to reform Medicare and Medicaid, and you also know that RFK Jr. is the health secretary, and he will be going for more transparency on the part of pharmaceutical companies. So it could be a bumpy next 2, 3, 4 weeks as the new administration comes into office and kind of shakes up the pot a little bit, right? That being said, daily uptrend is still here. However, if you lose these lows, 139.15, that will be a loss of the daily down uptrend into daily downtrend, and you're going to be looking for the weekly bulls to step it up, get the trend change in motion, because if they cannot do it, guys, just going to roll over and probably at that point heading down all the way here, 133, 132. So keep that in mind for healthcare, please. The bounce is nice, but still, guys, a little bit of overall sector weakness. So I'm not really interested in playing many names, but one that I could be considering is UNH. If UNH comes back down here, 500 to 480, could be interested in playing this very massive support area that's been there for roughly the last 2 years of trade. Moving into semiconductors right now. So semiconductors, 2.36%. They're trying to go for it again. This entire rally was undone. Now they're trying to make an attempt for it again, but all in all, guys, we're still trapped between overhead resistance 260 to 250 and below support 230 to 219. Maybe, just maybe, in the short-term future, we will not be trapped anymore. This is one of the best weekly closes that we've had leading into the top end of this range. But look, it's happened before where we've had a very bullish weekly candle into here and gotten rejected and just come right back down. So until we can close a weekly candle above 260 resistance. I'm not going to give the breakout to the bulls. A few key indications here right now, though. Weekly MACD is looking like it wants to cross. Bullish momentum is very nice, and the bulls have now a lot of space on the daily above 241, looking for the daily higher low for possible daily trend change, right? Because we lost it right here. So a new daily uptrend change and weekly uptrend continuation beyond the resistance highs. So keep that in mind for semiconductors. And if we get rejected again, I'll just be doing the same thing that I've been doing for the last 3 months, which is writing some puts on my favorite companies below the market. And if I get assigned, no problem at all. I like the levels. And if I don't get assigned, I'm just collecting some of that juicy premium. Moving into the Russell right now. So the Russell continues to be a little bit muted, right? One of the worst performers on the day, just because overall, guys, I mean, it's still a constant struggle with interest rates and whether or not the risk on trade is truly back or not. Moving in, we are into resistance right now, 232 down to about 226, which is for all intents and purposes, the range highs of 2021. And that being said, guys, in terms of the weekly, well, still a weekly downtrend, but a very nice weekly engulfing move, such as many other indexes in the market right now. So everything looks okay, but guys, we need to confirm the new daily uptrend. At this point, anything above 214, we'll be looking for the daily higher lows for possible further trend continuation. If we cannot get this done in one clean shot, may have to make a second attempt at breaking through this resistance range, but not looking too bad, all things considered on the Russell, just a little bit muted and once again trapped between resistance and trapped above support, just in somewhat of the same process we were back here before the election breakout. So we'll see whether or not what has in store for the Russell next week. Moving into the Dow Jones now. Well, the Dow Jones is actually looking quite decent. One more engulfing move from the markets right there. It was a daily downtrend for the longest time since the early portion of the month of December. And now we're maybe looking for, once again, the daily higher lows for an actual official daily trend change. Anything above 41.9, looking for the daily higher lows for further trend change. I will be looking, guys, all of these, SPY, QQQ, everything. I'm looking for the higher lows to buy to make an attempt for the daily trend changes as a whole. In terms of the weekly, guys, not looking too bad. It was a weekly downtrend reacting nicely from the final destination of support. Now we have the weekly engulfing move. So we will see if they can confirm the daily uptrend into next week. It will be looking very good for us being able to maybe create enough space to then eventually reset the weekly uptrend as well. As of right now, it is looking quite good. That is it for most of your major sectors. Now the minor sectors, we'll run through these quickly as we do every single Friday session. So XLP, guys, consumer defensives, think, well, I'll just show you, right? Walmart, Costco, Procter & Gamble, the tobacco companies, Coca-Cola, Pepsi, etc., trying desperately to find some sort of a local bottom. We know it's been largely, right, a massive weekly slide on that. And in terms of the monthly as well, right, you can argue it is now a monthly downtrend. Where are we coming into? Well, first stop is right here. It has to be the range highs of the previous range in 2022. So we're reacting from those somewhat nicely. I know my line's crooked, my bad, I just fixed it. Reacting nicely from the monthly 12 EMA. And on, officially it is going looking for a breakout, retest, and possibly run through 2025 when consumers are supposed to be on better footing, interest rates will come down, and the economy is supposed to be strong. Obviously, any recessionary data or massive job loss will undo this trade because it's consumer staples, right? At the end of the day, they hold up better than consumer retail or consumer non-discretionary, but they are still consumer exposed stocks. That being said, daily oversold conditions on this one right there, looking eventually for a daily trend change. And only when you get it can you say the weekly lows are set. And then on the weekly, have to do a lot of work for the bulls, guys. Have to reverse this into a weekly uptrend, and then we can start talking. But a nice little attempt for this right now. We'll take a look on the progression of this as we move forward. But some of my favorite consumer staples, as they call them, arguably are Coca-Cola. Pepsi is another one that's up for consideration too. That one is fairly decent, but my favorite one of them all right now definitely has to be Coca-Cola, and starting to have a little pop off of an area that I've been telling you guys about for arguably the last 4, 5, 6, 7, 8 weeks. So hopefully Coca-Cola can benefit. And also, I mean, this is arguably consumer defensive, right? You can say it's not consumer defensive. Some people don't put it in there. Some people do. Some people say it's non-discretionary. But McDonald's is more solid than not. 281 out of 273, guys. Not that bad on the monthly. 26 EMA touch, going for the monthly uptrend shift to the bulls. And usually when you buy McDonald's around the 26 EMA, it's a pretty good opportunity, guys. This is COVID, and this is the earlier downslide that they had back in the month of June when we had inflation concerns, rate higher for longer concerns, et cetera, et cetera, et cetera. McDonald's now largely dealing with the same concerns over the last 3-4 months. We know value has been somewhat weak, but this has usually always been, historically at least, a decent opportunity to make an attempt at a swing trade for McDonald's. So I'll be looking at those two stocks myself. Moving into utilities right now. Utilities, look at this bounce on utilities this week, largely because the yields have been coming down. And you can see right here, nice engulfing move on the daily, looking for the daily uptrend recapture, of course, similar to everything else. Weekly was in a little bit of a challenging location, but now we have the engulfing move looking quite nice. But once again, need to set the daily uptrend, need to push this weekly candle a little bit higher, and then eventually they will need to reset this into a weekly uptrend. But all in all, reacting nicely from 76 down to 71, which I'll remind you, we were saying it's a monthly uptrend. Coming into the month of January, this is exactly what we were saying, right? After the December close, when we looked at the monthly candles, coming in, breakout, retest, and possibly run as rates come down through 2025. Maybe not as fast as Wall Street wants, but they will be coming down next year and through 2026, right? So looking pretty good for the expansion of the utility sector. Real estate, another one that's affected by interest rates, finally getting a bounce. CPI did wonders for this sector too. So once again, engulfing move, looking for the daily uptrend recapture and looking to put in some more space on the weekly. This was a weekly downtrend, engulfing move. If they can engulf a little bit more, give themselves a lot of space and reset the weekly uptrend. And thereafter, you will know that your monthly consolidation is over in this beautiful monthly breakout, retest, and possibly run. We were also looking at this scenario, so it could be a decent time, guys, for some of the real estate names, some of the utilities names that have been beaten down. My favorite real estate play of them all, arguably, is Vici. Special shout out and consideration to O Realty Income, both at very nice long-term support levels. Here is O, and there is Vici, both at very nice long-term support areas. So take with that information what you will, but I may even be looking to play those as well. They move slow. I know they move slow, guys, but they could be a consideration for you if you are the type of individual who likes playing REITs. Moving into the energy sector, well, energy has come up significantly, but it's not because of what you think. It's not because of Trump or any uncertainty whatsoever. If anything, Trump's policies of drill, baby, drill are going to put more supply into the marketplace in terms of that, right? This has just been a commodity rally as a whole. Not only oil, but all of commodities because of the speculation surrounding tariffs and speculation surrounding a resurgence of inflation, right? It all starts with commodities. That's where inflation starts in the first place. And speculation on commodities is, pretty rampant, right? More than other sectors. I'll also remind you about the oil seasonality, guys. This is not a secret. It happens every single year. The reason why I closed my oil trades on early October, because October, November, early December is down for oil. But then look what happens end of December. You get a rally. Well, what happened here? End of December, you start getting a rally. And then what also happens in January is a little bit of muted action, usually in the month of January, but then early February, end of February, that's when you get the rally, right? Into the spring, because there's more demand for oil across the globe, of course, right? So although this chart on XLE is not perfectly mirroring the seasonality from oil, you get the point, right? Weak in the fall and through the end of winter into the early months of spring, that's when you see the curl, and arguably that's what's happening for a lot of these energy companies. That being said, looking not too bad on the weekly, recapturing the big level, 91 down to about 86. Not looking too bad, guys, in terms of the energy sector as a whole. If you are trying to front run this, as you should be, if you're looking to play oil plays, this chart should be like your desktop background, essentially, right? Because a lot of the market just moves off of supply and demand for oil. And when the spring starts, more demand for oil, guys. Think more cars, more transportation overall, right? More travel, more as well. Agriculture season starting everywhere. And that's a big demand on diesel fuel, right? So all those things combined, and a few more, of course, lead to this seasonal demand in oil. So you should be glued to that chart. And now could be a very interesting time to possibly position, now that we've recaptured these levels, possibly a decent time to position if you're confused which oil company to choose from between Chevron, ExxonMobil, Royal Dutch Shell, Halliburton, and so many different other ones, guys. Maybe the best bet for you is just trading the ETF XLE for exactly that, right? Just the energy trade overall, because most of the biggest components of this sector are, well, there's a few other sectors in there. Well, they're not sectors, but a few other names, right? Some of the electric companies, some of the nuclear companies are in there as well, but largely, a lot of the weight is oil. Now, moving on further, guys, in terms of the 10 and 20-year yields. So the 10 and 20-year yields are not too bad. Now, they have been coming down for the last 3 days in a row, but we know it's probably not going to be a cascade waterfall, right? It's going to be a bumpy path, some days up, some days down. But what you want to see here is this engulfing move continue a little bit, because as of right now, guys, it's a very nice reduction from the highs, right? About a 78% retracement down. So that does give the bears the best opportunity to set the lower high into the lower lows. This is yield bears, which means bond bulls, right? They're completely inverse to each other. So that is what you're looking for in terms of follow through over the next 2 weeks of trade, which could lead us into the topping out of this current weekly leg. Remains to be seen if they set the weekly higher lows and go higher, of course. But if that does happen, if you do get the daily downtrend, the next step is looking how much of this weekly move is going to be taken back by the bears. Same analysis we do on the SPY, right? When we're looking for a bounce to the upside and daily uptrend confirmation, this is just the inverse. How much of the move do they take back? Take back more and more of it. Well, it favors the rollover perpetually, right? So that is everything for the 10-year yield. The 20-year yield is the exact same analysis as a whole, guys. So this trade is going to be bumpy. It is very tough to call this the actual cycle top. Now, what CPI did is it provided a short-term local top opportunity in terms of being one big actual data catalyst to prevent yields from further skyrocketing. The only thing that will progressively bring these yields down over time in a big way is going to be hard data. Because when there's a lack of hard data that goes to show that yields should be coming down, you guys see what happens, right? Speculation takes over and we just start moving higher and higher and higher and higher, not really off of much news, just literally off of bond trader speculation. So if we keep getting some good hard data and we finally start to be able to price in some of the effects of Trump's tariffs, when we start to know what his tariffs are actually going to be, well, that's when you're going to see some of the final moves in yields. So if we want to take a bottoming trade in bonds, I'm not opposed to making an attempt. Let's say if we have a little bit of a retrace here, yields move a little bit higher on the Monday or Tuesday session with Trump volatility, we can possibly find a higher low and go for the daily trend change. But essentially what I'm saying is, even though we're very close to October and November 2023 lows, and it does seem like a very good entry, this one can move slow, guys. It could just literally stay muted here for the next 30 to 60 days. So short-term calls may not be the best, but if we're looking maybe January 2026, June 2026 as well, those could be interesting strikes if we're looking to make a longer duration play on the longer duration recovery of the bond market as a whole. But it's not Palantir, guys. It doesn't move as fast. So you have to give your contracts a lot of time, especially if you're using calls. And even if you're playing TMF, right? Extend the time horizon a little bit more than you usually would with normal stocks. Moving into gold, gold actually had a very good week as a whole. Another byproduct of the commodity rally. Tightening range, now looking to possibly break out. You need a breakout of 2720 to confirm the weekly uptrend breakout. And at that point, you're probably going to the psychological numbers, 28, 29, and then of course 3000, but not getting ahead of ourselves. We are still in the context of a tightening range as a whole. All in all, looks very good though. Daily uptrend is nice, looking for a higher low, anything above 2662, higher low, and then you're looking for the break. If you can get a break, retest, and then run this retest area, could be a very interesting area for a trade overall on the gold as a whole. And if we come down to, I wouldn't be opposed to playing a little bit of gold down here around the 2600 region if ever we start retesting the lower end of this tightening range, right? Moving on to oil right now. Well, oil benefiting from the rally, of course, in the commodity sector, but also, as we just saw, the seasonality from end of December into early portion of January before maybe seeing a little bit of a decline. So I would not be surprised now that we've had a tremendous rally in oil over the past few weeks. Daily overbought condition, big engulfing candle. Now we might be able to see a little bit of retracement down there and start setting the weekly higher lows for possible further trend continuation on oil. It's not me, guys. Here is 2023. November, December, then what happens? Tail end of December, get the oil rally, a little bit of pullback here in the end of the month of January, and then February and March and April. February and March and April, right? Clear as day. It happens every single year. So you guys should really not be surprised, right? Here's that's 2023. Here's 2022, leading into 2022, 2021, down, right? The fall, then big rally, January, February, March, April, and then you get the declines thereafter, right? So it happens arguably more often than not, arguably every single year, right? So moving into that, guys, that is the analysis on oil. Could be looking for a higher low for possible expansion here into the early months of the year. So it should be very straightforward. In terms of the market breadth, should have done this when we do SPY, but we'll do it now anyways. Market breadth, guys, we are now back to before Powell. Here's when Powell destroyed us, and we've been sitting down there ever since. In terms of percentage of stocks above their 20-day, you can see now, guys, the market is getting a lot more broad. If I put this on a 1-month relative performance, right, everything now, except for big tech, a lot of things are coming back. Because if I did this a week and a half ago, this entire heat map is bright red. Now we're starting to piece back together portions of the puzzle, which leaves us not too bad. So percentage of stocks above their 20-day moving average, not looking too bad, now back at 62%. I was saying that down here is a buying opportunity, traditional to history. Down there is usually always a buying opportunity, but buying carefully and slowly. So hopefully you guys are able to get some dip buys in, looking not too bad there. We are now back to normal territory where 62% of the stocks are above their 20-day moving average. So market breadth is getting fairly good. Fear and greed index is still at fear. You can see market momentum still at fear. Stock price strength, net new highs and lows. Uptick, very nice upticks, but still at relative lows. And the breadth, even in this indicator here, still at extreme fear, but the breadth is improving overall, right? So this is another indicator that the breadth is improving. Percentage of stocks above their 50-day moving average. Well, you can see the damage that Jerome Powell did. We are still not back above in terms of percentage of stocks above their 50-day longer moving average. So what this says is, now stocks have had a quick recovery and they're back above their 20, but maybe not as big as a recovery to put them back above their longer term moving averages, which would need a bigger size move in some stocks as a whole, right? Now, this one is still at 40, which is still traditionally low in the grand scheme of historical norms, but is improving week over week. And lastly, percentage of stocks above their 200-day moving average as well, not looking too bad there, guys. 54%, which is still somewhat weak in terms of where we've been throughout 2024, but still not at the lows that we saw at least a week ago at about 46%, which was also some form of a buying opportunity, just looking back at the last roughly 2 years of trade before, well, after the massive bear market that was 2022. So that's pretty much everything, guys, for your index analysis. I spent a little bit more time on it this week because it's important, always important to study rotation, and hopefully with me going over sector by sector and showing you guys what I'm looking for rotation, showing you the levels, weekly, monthly time frame analysis, hopefully gives you a better overview of where the market is heading, especially in relation to the big point here, which arguably is yields, right? Now let's do a little bit of crypto and then we'll move into some stocks. So I'm looking at Bitcoin right now. Bitcoin up about 0.45%. Not the worst day for Bitcoin at all. As a matter of fact, or actually, sorry about that. Bitcoin on last day, because I keep filming these videos running into the candle closes on Bitcoin. So my bad. Bitcoin was up at one point over 5% yesterday, or today rather, on Friday. This candle, anyways, that just closed about an hour or two ago. So moving on further, Bitcoin is looking quite healthy, still looking for that daily uptrend though, need the higher low, but now it opens up the door for one very clear scenario, the breakout, retest, and run. However, keep in mind, Bitcoin sometimes does not even give us a retest of a big level before just running. So could this be a case in point of it doing that as well, leading into the Trump inauguration? Possibly, but we'll see. If we do get a retest, though, could be an interesting opportunity. Breakout, retest, and run for a trade entry here, and going for the trade as a whole, guys. Not looking too bad for Bitcoin, everything considered. On the weekly is also looking quite good, since they are now about to close this weekly candle. I can't really close it before Sunday because the weekly candle close is on Sunday. So we'll see what happens, but the weekly definitely is looking very poised to go into another leg of weekly rallies. The next stop of which, guys, in my opinion, is probably going to be 120, 125K for Bitcoin. Looking very solid as a whole. 104K, nothing bad to see there. In terms of Ethereum also with a decent day. Still kind of need the daily uptrend because they have not set it just yet. Daily downtrend, nice daily rally. Needs some form of consolidation, set the daily uptrend, and go in motion for that. In terms of the weekly, also not looking too bad. Weekly downtrend was the case, but now we have a very nice weekly bounce, but still not out of the woods. But we did react nicely from support below 32 to 33,000. This is all beholden to Bitcoin, guys. If Bitcoin rallies, Ethereum's going to rally, because as we've seen, Ethereum does absolutely nothing on its own. It only moves when Bitcoin moves. Why? Because the rest of crypto is doing the same thing as well. They only move when Bitcoin moves. Bitcoin is still the dominant player, and dominance has roughly been flat. When it goes down, altcoins and other coins are outperforming Bitcoin, but it does not mean that Bitcoin is going down. It just means that Bitcoin is flat or going up less quickly than the rest of altcoins are going up, right? If you want to see some real performance in Ethereum, outperformance in Ethereum, Solana, and every other crypto that you can possibly name, other than meme coins, of course, those move on their own, but some of the bigger ones, right? You need to see this dominance chart come down and set a weekly downtrend. So far, we do not have that as of yet, but it could be coming if Bitcoin puts in another rally to new highs and then consolidates. That's when maybe some of the altcoins can really start coming alive. But as of right now, all eyes are still currently on the Bitcoin trade. That's everything for that. Now let's move into big tech names, shall we? So looking into Apple first. Apple up about 0.75% today, guys. Not the best day for Apple, but then again, not the worst day either. Green day, but a red candle to say the least. So Apple continues to remain a little bit weak. Still in the context of this daily downtrend, we'll be looking for a bounce though. The bulls still not able to get together the hourly trend change. I'll remind you, we need to see the hourly trend change to confirm that the daily lows are set. And then we're looking for the size of the bounce in relation to our most recent lower high. We'll need to get a very good bounce to set the engulfing move to possibly reset this into a daily uptrend. If they are not able to get it done, guys, because overhead above us right now, this whole area, 235 down to about 230, that is now acting as resistance, right? So little resistance up here, more resistance with the moving averages. We will see if Apple can get it together next week, put together a little bit of a bounce, because if they do not and continue sliding, we are heading down below to the next area of support, which is arguably 225 down to about 216. The 200-day moving average is right there as well at about 220. Overall though, guys, still in the context of a weekly uptrend, looking for a weekly higher low, anything still above 220, looking for that higher low. But the more and more the bears pull back of this move, guys, loss of momentum, you're probably not going to get the V-shape to all-time highs. If anything, they will have to do a two-step recovery process similar to exactly what happened back here. Weekly higher lows, weekly uptrend, loss of the weekly uptrend, and now look how long it took them to finally break above. So it can take a very long process when you lose all of the momentum. I'll remind you, one of the complaints that people have about Apple right now is the flat revenue growth year over year and the very high valuation right now at about 230, which is roughly a 3 peg. Very high valuation for a company that is not growing very well at all, especially over the last 2-3 years. I still love Apple as a company, guys, but we have to admit the valuation is very high for not having that much revenue growth. I'm still bullish on the company in the long term, but at least maybe the next 1 to 2 quarters as they move through somewhat timid iPhone sales could be quite challenging for the business. All that being said, if I'm looking to buy Apple, I really start to get interested between, under 220, closer to 210 to 200, but we're not too sure we're going to get that. That will be a top to bottom decline on Apple of roughly 20 to 25%. And you don't usually see those that often. The extent of which you can find some declines is usually about 14, 15%, which would put us at this lower support area. You can see this one back here was just that, about 15%. This one right here as well, about 15%. This one, top to bottom as well, was about 15%. So in the context of bull markets, guys, that's usually the most you'll get out of Apple, unless it's something is truly wrong under the hood for Apple, which I don't think is the case right now. Just going through a little bit of sector weakness, but that has been the same, guys, for all of the consumer electronic segments, whether it's iPhones, tablets, computers, everything, guys, for the last 2 years have arguably been very weak in comparison to the booming years of 2020 and 2021 when everybody had free money, stimulus checks, and everybody went out there and bought the newest electronics. And now the refresh cycle may just be pushed back another year or maybe even 2. Moving into AMD right now, AMD up 2.55% today. I mean, a decent day for AMD, guys, but let's not get it twisted, right? Still have a lot of work to do for the bulls. We know we lost the daily uptrend, engulfing move to the downside. They had pretty much the flush going, and now above us is resistance. 123 up to about 135 is resistance. And the bounce size, if they were to lose this right now, the bounce size is just not good enough, guys. The bounce only about 50% bounce. It gives the bulls a 50% chance of resetting into a daily uptrend, but it also gives the bears a 50% chance of retesting the lows and flushing lower. If we get the lower scenario, guys, we are coming down here, 113 down to about $100, which is roughly the last line of defense down there. We are reacting nicely from the 200 weekly EMA, this green line right there, which other than 2022, guys, this line has really not ever been tested You'd have to go all the way back to 2017 to find it tested. And prior to that was the period of time where AMD really wasn't doing too well at all, but neither was NVIDIA for that matter. But in the context of since AMD's expansion with the Ryzen series and their new advancements in graphics cards, they have been doing a lot better, and they have not really tested this 200 weekly EMA. So not looking too bad, but we can see some further declines. I'm not calling any bottoms on AMD. The best that we can do is write short puts under the market if we want to be assigned and want to own some shares for the potential recovery thesis for AMD, which represents a very cheap valuation right now, decent revenue growth and EPS growth for the next couple of years. I will remind you of the thesis. The thesis has always been not to be the next NVIDIA, just to at least serve some of the data center market, some of the inference market as well. Average price target from analysts is about 172, even with the recent downgrades. EPS expansion should be very nice, 25, 26, 27, and revenue expansion as well. Arguably some of the best years that AMD has ever had in the last 10 years overall. That is the thesis for why we should buy AMD down here, but I'm not trying to convince you guys. I know AMD is a very polarizing stock. Either you love it or you hate it. Overall, though, I do think it's a more favorable risk to reward profile, but notice I did not say there's not any risk. It's just the reward profile, in my opinion, is more favorable than the risk right now, because the risk, if you ask me, is maybe all the way down to $100 max pain, especially at this very cheap valuation already. But the upside could be the average analyst price target at about 170. That's a very decent risk to reward profile, if I do say so myself. Moving on to Amazon right now. So Amazon up about 2.4%, looking quite good, guys. But Amazon as well was kind of just trapped in this downtrending channel. We've now broken above that, but price action is king, guys. Even over and above these channels right there, I want you guys to focus on the price action. Higher highs, lows, lower highs, and now it's up to the bulls with the size of this move to reset into a daily uptrend. Two ways of doing that. Either you engulf and do it like this, or you set it like this a little bit lower and then go for the high. Either case scenario would be good and would hint to the fact that we are done weekly consolidation on this stock and may just be looking for another weekly leg higher. They obviously have their earnings coming up in just a few short weeks time, so we'll pay special attention to that. I would be highly surprised if Amazon either breaks down a big level such as the 215 and a 208 support area below us, but I would also be surprised if they do much of a big breakout beyond 233 much before their earnings in 2 weeks' time. I think they may stay a little bit sidelined until then, as would most of big tech until their respective earnings. But Amazon's still a fantastic company. Moving into Google right now. Google also up about 1.62% today. Still kind of trapped, right? Overhead supply or resistance, about 198 up to about 200 psychological right there. And below support, 191 down to about 188. This is an okay support level. The reason I say that is because they did a good job of protecting it since December, but it's only just the previous all-time highs. Arguably the biggest level of support is down here, roughly about 182 down to 175. I'm not saying Google is going to go down there. I'm just saying that if it comes down to the lower end of here, 187, 185, I will probably be looking to write some short puts to get some shares quite aggressively leading into their earnings. I love Google at this price right now, even at 196. I know it looks like the all-time highs, and I know it looks like you're late, but the valuation here is extremely cheap, guys, in relation to almost all of the other technology stocks, namely the Mag 7 names. This is the cheapest name of the entire bunch. And when your profile in terms of expansion looks like this, in terms of EPS expansion and revenue expansion, and the average price target is about 220 all the way up to 240, it does look pretty good for some continuation rally into 2025. 225 is my personal target for 2025. That's a tongue twister. 225 for 2025 on Google is my own personal price target. So if you come down here, guys, I will be looking to arguably buy the dip. But as of now, Google not looking too bad, just looking to reestablish some form of daily uptrend and push beyond the all-time highs. But they as well have earnings the 4th of February. Moving into Meta stock right now. Meta up about 0.24%. Not the best day for Meta, but then again, Meta did end green. This is kind of like NVIDIA, right? Just trapped in or around the all-time highs. They're trying to go for the daily uptrend expansion right now, but just kind of getting a little bit shut down here at the highs at about 630. So not looking too bad. Below support is 597 down to about 582. If Meta somehow breaks down below here and I can find some opportunities, let's call it, 560 to 530, I would be looking to buy that little pocket, but we may only get such a drop if for some which reason their earnings It's just not interpreted that good by Wall Street. I'm pretty sure they're going to have good numbers, but it's the interpretation by Wall Street, which is always what sends these down more so than not often, right? They did it back here. They did it a few times in the past. Nobody would be surprised, right? They had great earnings here, sent it back down. They had fantastic earnings here, sent it down like 8-9%, right? So it can come down. So I will be patient and wait for my 560 to 530 target. But if not, and it just rallies away, perfectly fine. I have some long-term meta shares. So right now, in my opinion, not the best buying opportunity. It is still a weekly uptrend though. So if you're looking for some possible expansion, I mean, the breakout, the retest, and the possible run is still an opportunity if you want to take that risk before earnings. Completely up to you. Moving on further, guys, the next one is going to be Microsoft, of course, if I can get my list together there. So Microsoft not looking too bad today, but once again, another day for Microsoft where we start off strong and we end towards the low of the day. Microsoft got all the way up as about 434 today and ended about 429. Microsoft just does not want to leave any gaps behind it, truly, well, unless you factor in that one down there. But all in all, guys, the bounce size is very good. The context is a daily downtrend. Now we have a 100% engulfing bounce. This gives the bulls the best chance of resetting into a daily uptrend. And I'll remind you, the last time we had a fully engulfing bounce, they did reset and moved a lot higher, right? It was this move right here, as a matter of fact. So moving on, guys, we're going to be looking for a daily higher low, anything pretty much above 411, looking for that daily higher low for further trend change. So what I'm saying is any further consolidation from Microsoft back down into the 420s, I will be possibly buying through the intermediary of writing some short puts, or maybe even adding to some of my call debit spreads that I currently have on the stock. Not looking too bad. That being said, we once again got rejected by resistance, 433 to 425, right? This has been an area that's been very challenging for the bulls to break through, use as support, and then rally for real. So we'll see if Microsoft can do that. Microsoft has earnings 27th of January, so maybe a little bit muted, not expecting a massive breakout, and I'm also not expecting a massive breakdown below support much before earnings, support being 405 down to 390. Moving into Netflix right now, Netflix up about 1.87%. Not looking too bad, guys. The context is still a daily downtrend. Nice sized bounce, but in relation to the lower high, which is all the way up here, the bounce size is quite weak, right? Arguably only 25-30%. They do have earnings next Tuesday though, guys. So there's literally no days of trading, only Tuesday, because Monday's a holiday before Netflix has earnings. I'll remind you, the expected move on Netflix is about 7.5-8%. 8% to the upside on Netflix would put us right back at the all-time highs. 8% to the downside on Netflix would put us in a very nice buying zone, which would be roughly 775 down to about 750. That's where I would be interested in buying Netflix. I think by that time, it would probably be daily oversold conditions, and it would also be testing arguably slightly below the 26 EMA, which has always been a decent buying point for Netflix throughout this entire rally phase so far. Decent little opportunity. So if we come back down there, guys, it would be an opportunity for buying. We would also just be looking to set the monthly higher lows for further trend continuation. So if we come down there, I will be a buyer. But if we move all the way up to all-time highs, I will not be buying. I will not be FOMO buying in. So if you want to position before earnings, guys, it's pretty much Tuesday or never. You have to take your chances with it. We're not really close to support. We're kind of in the middle, right? And no man's land. There is nothing here. So it's equidistant risk and equidistant reward as well. So do with that what you will. Moving into NVIDIA right now. Give me a very brief moment. I used to take the coffee sips at Google. Now apparently it's NVIDIA. Oh well. NVIDIA up 3.10% today. But all in all, guys, anything on the chart change? No, we are still trapped between overhead resistance 147 to 142 and below support, which is 130 down to about 125. That being said, we are also trendless. They had the daily uptrend here. We lost it, and now we need to set it up all again. So we will see if this move takes us up into resistance, maybe initially get rejected, set the higher low, and then go for the daily trend change and the resistance break ahead of us. But if it breaks down, well, I'll remind you, below support 130 down to 125. And if we break down into there, I will be looking to write some short puts, lower 120, closer to 200-day moving average. That would be a top to bottom decline from NVIDIA of roughly 22 to 25%. In the context of NVIDIA, usually, look at all these declines, top to bottom, right? 20%. This one right here is about 28% for the Japanese carry trade. This one in the month of March 2024 to June, let's call it, or May rather, that one was 21%. And all the way back here in fall of 2023, top to bottom also roughly 20-25%. So if NVIDIA drops down there, I will be a big fan of buying NVIDIA. I am still buying NVIDIA a little bit. If we come down here, I'm nibbling little bits of pieces here, but if we come down there, I will be going heavy and probably adding a leap contract to the one that I currently have, which I bought not too long ago, right around where we are, around the 137 just a few short weeks ago. I will be adding more down there. So as a whole on NVIDIA, nothing is looking too bad, guys. It is just monthly, arguably sideways consolidation, close to the all-time highs. The monthly as well, same thing, just monthly sideways consolidation, close to the all-time highs. The guidance for NVIDIA is very good for 2025, and what we heard from TSM and from Micron is the demand for them is extremely strong as well. Moving into Tesla. Tesla also having a very decent day today, but unraveling a little bit towards the end of the day. Tesla at one point today, you guys will see it, right? Tesla was up pretty much over 4.5% on the day. Well, actually more than that. Sorry, they were up almost 6% on the day before giving back half of that in the last roughly what? An hour of trade, just a little bit of profit taking. Tesla has had a very good week since the Monday session. Bottom to top rally on Tesla this week. It doesn't look like it, but that was 15% bottom to top. That being said, if we roll over a little bit more, we'll be looking to set a new daily higher low. This is a new daily uptrend, looking for a new daily higher low, anything above 376, looking for the higher low for possible further trend continuation for the bulls. Below support is 408. Down to 380. I'll remind you, that is the previous all-time highs, which were resistance. Now they're acting as support. It's the good old breakout retest of a prior range. And now we're looking for the possible continuation of the expansion. Tesla does have earnings the 29th of January. So similar to Netflix and similar to the rest of big tech, I'm not expecting any crazy breakouts of the all-time high, nor am I expecting any breakdowns below massive levels and massive flushes much before earnings. So Tesla could just stay a little bit range bound, although we know Tesla has a wide range, could stay a little bit muted there until their earnings. We will see, of course. Trump coming into office next Monday. Elon Musk is going to be there. We'll see what happens. There may be some hype and some momentum leading into Tuesday, but for all intents and purposes, if you want to see some major level changes in terms of breaking a major level here or possibly breaking a major level there, in my opinion, you may need to wait until Tuesday, the 29th, or Wednesday rather, the 29th of January for that. But all in all, the bulls looking strong and just need to protect this 376 as support. Moving into Palantir right now. So Palantir recapturing a little bit more today. Nice 5 days worth of bounce with the rest of the markets. The context, though, is still a daily downtrend, and we are still barely, but still within the confines of this resistance range, 72, roughly down to roughly $68. So that being said, guys, not the worst performance by Palantir, but I'll remind you who's in control, and I'll remind you as well the size of the bounce. The size of the bounce right now, about 50%. So it gives the bulls a 50% chance of resetting into a daily higher low and higher high, daily uptrend, and it also gives the bears a 50% chance of just rolling over and retesting the lows. I would like to see more of a bounce from Palantir up to roughly 75, 77 to give the bulls the best chance of resetting, using this current resistance, then as support, resetting into the new daily uptrend. That will be a confirmation that the weekly lows are set and possibly looking for another leg of weekly momentum higher on Palantir, the extent of which will be psychological resistance of $90. If we cannot get it done and we break down from here and flush the lows, weekly consolidation continues and you're looking at $60 for the next support area. At that point, I will be playing some Palantir short puts, probably down 55 to about 50 bucks. Not that bad of a range, in my humble opinion. Even though valuation is elevated up here, guys, it could be a decent trade, especially considering Palantir would be down from the highs, roughly, 34, all the way down to about 40%. That would be a buy, at least for a momentum swing trade, in my opinion. And now lastly, SOFI. So SOFI, arguably, out of all the momentum names, guys, out of all of them, out of SoundHound, out of even, arguably, the quantum computing trades, which have been the highest momentum trades as of recently, right? Now, I know percentage gains, the bounces on quantum computing have been a lot better, right? Like 100% bounce on QUBT. But in relation to where we started, to where we are, and the trend, I feel that SOFI, amongst all of the names, has one of the better engulfing move bounces, right? Looking very strong, daily lows, daily downtrend were set. Now we have a nice engulfing move, creating a ton of space. Anything above 1358, looking for a daily higher low for a new trend change back to the bulls. Because it was a daily downtrend, need to get the trend change. And that will let you know that, yes, the weekly lows are set. Look at the size of this bounce, guys. I know it's not quantum computing bounces, but still for SOFI, guys, 22% from the lows to the highs. That's better than everybody. It's better than Palantir. It's better than Tesla. It's better than SoundHound and a few other of the names, right? Even if you look at the other ones, like IONQ had a very good bounce. They had 44% bounce. But then again, where are they in relation to their highs? They have not reclaimed the highs as of SOFI actually did reclaim the highs, right? So obviously, you know what I mean by now. SOFI not looking too bad at all. On the daily, on the weekly as well. Big weekly candle engulfing move, guys. Would not be surprised if the bulls can indeed reset into a daily uptrend, reset the weekly momentum higher a little bit. And the next price targets, guys, are going to be $18 to about $20. Looking very strong on SOFI overall. This has been a very nice period of consolidation. I did buy the dip nominally, not as much as arguably I should have. I was waiting for a little bit more, but that's okay, guys. I'm perfectly fine with missing out on this rally a little bit. I have a ton of other names that I am not missing out on any gains whatsoever. So SOFI, congratulations to all the bulls out there, looking pretty good. And also daily, MACD has now been crossing after being negative momentum for roughly a month's worth of time. So that is notable as well. All time frames are looking fairly good, especially the monthly, guys. Look, monthly higher lows are possibly set for further expansion. That expansion is probably taking us definitely $18 to $20. The top end of these guys up here, at least the actual candle closes, not so much the wicks, right? So moving on down further, guys, that is pretty much everything for our stock market analysis, our sector analysis, our individual tech name analysis. In terms of the swing trades that I'm looking at, guys, before we get into the portfolio real quick, there's a few swing trade opportunities that I'm looking at right now. So I'll run you through them very quickly. One of them I mentioned previously, and don't expect any quantum computing names on this list, guys. These are just all very solid companies, very solid plays. They may be a little bit too conservative for you, but at least you're going to know what I'm looking for, right? McDonald's, number one. We covered it before. Tesla, the 12 EMA, monthly gorgeous bounce, looking for the higher lows for the possible trend continuation. McDonald's, guys, at the end of the day, is McDonald's, right? It should be doing fairly well through 2025 as consumers continue moving through the recovery cycle as a whole. So looking for that expansion on McDonald's, not a bad time to be looking for a position, especially when you have daily oversold, right? Below the 200-day moving average as well, plus daily oversold, usually not that bad of an opportunity. TJX, another retail stock, one of the few retail stocks that I do not mind playing. TJX, very nice setup. This is a bull flag. It is a breakout, retest, and possibly run. How many times so far has TJX done this exact same pattern, pulling back into the 26 EMA and then rallying, pulling back into the 26 EMA and then rallying, right? They're all the same trade patterns. Although we are rich right now, TJX, decent trade opportunity. The stop loss would go below this week's weekly low, because then that would invalidate the weekly breakout and we'd be heading lower, of course. And the take profit, guys, is roughly 127 to the level a little bit higher, which could be interpreted as being the extension perhaps of this trend line, which arguably would be about 135. So the risk reward setup on that one is not too bad, but maybe a little bit too conservative for you. That's where some options come into play, call debit spreads, etc. AutoZone, same setup. Bull flag, breakout, retest into continuation. AutoZone, one of the ones that does this setup all the time, just looking for a little bit more in terms of some trend expansion. I mean, I told you about Berkshire and MCO, but we'll revisit them. Berkshire also reclaiming the territory, looking for the higher low and the expansion. Could be a trade idea. MasterCard, same concept. These are all very high quality stocks, guys. Very high quality stocks that just went through a few weeks of consolidation and might be looking for further expansion, much needed cool downs, and now might be looking a little bit more with the broadening out of the market overall. Another one of those are Coca-Cola. Been saying this one for a while. It might just be ready with the CPI fear bottom blows and the recovery of the value sector as a whole. Coca-Cola not looking too bad. Lift off from this zone right here, $62 to $60. The risk obviously is a flush below, let's call it about $59. So you're risking about $3, and the upside appreciation is maybe 68 to 70. Sometimes it could take a little bit more time than expected, but such is the case for a lot of other trades. Uber, we're going to look at it a little bit in the long-term portfolio, in the trading portfolio rather. But if Uber, for some which reason, right, weekly downtrend, because this is a very nice weekly bounce, if we get the establishment of a weekly higher low and Uber comes back down below here, 62, I do think this one is a buy for possible recovery of the stock into 2025. Fantastic fundamentals, guys. The PE ratio and the PEG ratio are extremely cheap for a company that is growing this fast through 2027. So any retest of the lower $60 range, I am definitely going to be a very big fan of. Those are just a few of the names that I'm looking at as a whole, guys. right? I'll be giving you much more in the top 5 options video coming out on the Sunday session. But of course, another one you can argue, Micron as well, is looking fantastic for some expansion. Overall, guys, we just reclaimed the fear lows. I know it's not the lows. I was telling you guys here was a good area, but if we're looking again, a little bit more of a dip back into 100 can be a decent position, guys, for the semiconductor breakout. We're looking at SMH for the best possible plays, right? ASML, another legacy name. It's been beaten down. ASML, not the worst opportunity. No immediate clear trade setup right now. But if we somehow retest the low range of 712, 710, go for the weekly higher lows, could be interesting. Stop loss would go below 689, and you'd be looking for expansion, possibly into the previous highs of about 840. So decent risk to reward on that one as well. Those are just a few of the ones off the top of my head that I've been exploring more recently over the past few days. And you guys by now obviously know all the levels at which I want to buy big tech at. So now I threw to you guys a little bit more value plays as well, and a few semiconductor names that are on my radar too. So those are some of the swing trade opportunities that I'm seeing in the market right now. They may not move fast enough for you. They may not be the SoundHounds of the world. They may not be the Rigettis of the world, but they are very solid companies with very solid business models, very solid fundamentals, and expanding their free cash flows into 2025 as well. You guys know I usually always bring you high quality stocks, not so much the momentum trades, although these momentum trades can be good and do have their place in the market. You kind of have to trade them with a little bit more caution and define stop losses and take your profits periodically, guys. You know, if you start rallying here on Rigetti and you have a position that you bought down here, take profits progressively as you move up, right? No need to hold the whole bag up here unless you're truly risk loving and you just want to risk it all and go for the big home run. Up to you guys. It is obviously your own capital. I'm not here to tell you what to do. I'm just here to provide you with perspective. So now that's everything for the trade rundown. Now let's do a quick little portfolio recap and we're done. You guys know the Friday videos are always a little bit longer. So let's move into that right now. In terms of the weekly recap for the trades, guys, you will see that it was a very good week in the trading in the Discord as well. And well, this is the same account that I use for the channel, right? The YouTube portfolio that I created, essentially the trading account when I started the channel two short years ago, which we've now trimmed. It used to be 100K the last 2 years. I would net it out to about 190K and just trade with that with a little bit of margin. Now I've put it to a more manageable level. I started off the year with roughly 46, 47K, just under 57K to make it more like realistic. I don't just want to start with a flat 50,000, under 50,000. The Walmart pricing strategy, right? Rather than listing something at $10, you list it at $9.89 and people think it's cheap. Well, I put it under 50K just to make it seem more like it's only 40K. You know what I mean? Unfortunately, now it's back above 50K slightly. So I guess I can't win in that respect, but whatever. Anyways, all that yapping to say, here are the trades for the week. 6 wheel trades, 6 wins, BITX, Palo Alto, SOXL, Ethereum, SPLG, which is just the SPY, and TSLL. You guys saw most of these trades on the Monday and Tuesday update, but in case you didn't, here are the results of those. A lot of these, the ones that I closed, these ones right there, was closed before CPI and before bank earnings on Wednesday. I thought that it was the prudent thing to do because if they would have went the other direction, guys, we would be quite red in the markets right now, to say the least. So this was just risk management, taking the profits off the table. They were all made from the Monday to the Tuesday session anyways. Ethereum we took roughly about 2-3 weeks ago, so I took that one off as well on the Tuesday session. SPLG and TSLL, we just let run into the close. Very good profits there too. Assignments, Uber, we once again reduced our cost basis on the $66 assignment by another 60 cents by writing covered calls just the other day. I'll show you the assignment value right now. The assignment price is $66. The net average cost now after farming premium on the covered call side is down to $63.42. So we've already reduced our cost basis by a decent margin, guys, down to about $63.42. Looking good. We still have the covered calls now in place through next Friday. So that was a very good, successful venture on Uber as well. Directional trades, 1 win and 2 losses. The UNH call debit spreads that we bought from the UNH lows after Powell, they actually performed quite well. We bought them right here and we closed them just the other day all the way up there. So they performed very well. You can see that is a 60% ROI, $236 worth of profit on that one. Now, these one we took losses, but I told you this on Wednesday. We closed MCO and we closed Berkshire. Why did I close them? They're 2 financial companies and we were heading into CPI and bank earnings. So I took a little bit of risk off the table on those. 1.5% loss, same thing. We bought them after Powell. I bought Moody's Corporation right after Powell, arguably right about Here, we were in profit for a little bit. It eroded, triggered our stop loss, which is below those here. I waited because we had double gap down opens on SPY and QQQ Friday and Monday. I waited for the recovery Monday and Tuesday, and I told myself I am closing before CPI, before bank earnings. In hindsight, now that they're positive, you could argue that was a mistake, but we're in the business of managing the risk here, guys. And when we have two positions that are heavily exposed to those two events, you have to manage the risk and you have to keep the losses as small as possible, because right now we can just get back into those trades now that we have the information, now that we have the guidance, right? Same thing for Berkshire. We got into this one right after Powell, just about here. It kind of was in profit for a little bit, then break even, then the flush on the Friday session, of course. I chose to wait for a bounce because Berkshire was oversold on the short-term timeframes hourly, and SPY and QQQ double gap down Friday and Monday. I waited for the bounce, close them arguably at the high of the day on Tuesday. And then in hindsight now, it's very easy to say, well, that was a mistake because now it's in profit, but you did not have the CPI or the bank earnings as information. This was just cautious risk management. So you can see the losses here, $35 loss on Moody's and $172 loss on Berkshire. Both of these losses combined are nothing in relation to the UNH profit. We made more money on UNH than lost on these two trades, but look at all the other profits we had this week, guys, plus all the running P&Ls that are not closed. These are just closed trades, right? All the wheel trades profitable and the lottery trades as well. Momentum trade on TSLL, 16 cents to worthless, and TSM earnings trade you guys did not see, but I told you about it. 180 short put, $57, and we closed it for a dollar, 99% win there as well. That is all the closed trades. So another very successful week in the Discord and very prudent and cautious risk management by keeping the losses small in the face of CPI and direct sector related earnings, which would have heavily impacted these either way. You see the impact that those earnings had, right? Now imagine them the opposite direction and we'd be flushing levels left, right, and center. So now we can revisit these trades, right? And we haven't lost too much time or really too much ground. I'll be patient waiting for the higher lows for the possible expansion. So that's everything for the closed trades. Now let's look at my portfolio and then we're done. All right, guys, so here's the portfolio as of today, just above $50,000. Now, as I said, guys, this is the YouTube portfolio. I have a whole other bigger, much bigger trading account that I use for personal purposes, but this is the one that I started 2 years ago on the channel with all you guys to show you my trading strategy and how you can run the positions if you have a small, medium, or even large account, right? So as a whole, the performance year to date is fairly good, guys. We're up about almost 8% year to date. Not too bad. You can see we started the account roughly about 47, just under 47,000, and we're now back above 50,000 because I wasn't showing the value before because it was closer to 100,000. And I know how the game is played, right? When you see 100,000, especially if you're starting off in the markets, you think, well, you have $100,000. It's easy to make money when you have 100K, right? So I tapered it back to a more manageable expectation. I know some of you guys don't have 50K, but you'll notice that since I'm trading with less capital, a lot of my positions and trading styles right now are going to be for people that have arguably smaller account balances. These positions can all be replicated, and you'll see a lot of positions are anywhere between the smaller trades, $200 to $1,000, and some of the larger ones, of course, you'll still see $10, $20, $30,000 wheel trades as well, right? So I'm trying to find a good middle ground to include everybody in this journey. Now, of course, we do still have the dumpster dive portfolio, which is the portfolio I made in the sell-off in the month of September. We bought a whole bunch of companies that were underperforming the market, the likes of which, Baba, CCL, Caesars, Dollar General, Disney, Estee Lauder, Helen of Troy, Intel, Love, which is Spirit Airlines, right? Triple Ebb, Nike, Pfizer, PayPal, Papa John's Pizza, Rivian, this one here, Stanley, Black & Decker, AT&T, UPS, Walgreens, Whirlpool, and Wynn. I put $50 into each and every one of them back in roughly September, and I told myself, listen, is it a good we're going to test the theory. Is it a good proposition to be buying some of these companies down here, or is it just best to stick with the Mag 7? Well, so far, it would have been better to just stick with the Mag 7, but we're doing a experiment here. If I load up a portfolio of nothing but oversold and beaten down companies at historical lows, 5-year lows, 10-year lows, 15-year lows for some of them, can it beat the S&P 500? And as of now, yes, it is beating the S&P 500. But as you can see, guys, it is not beating the S&P 500 more than my trading portfolio, and not even really more than that, right? It's not as if it's having some tremendous outperformance. Matter of fact, since I started it back in September, you can see we are literally flat with the S&P. So overall, not the best in terms of experiment performance, but then again, I only did it with $1,000. It wasn't so much the amount that I was doing it with, it was just to prove the experiment. So we'll keep a track on this. I'll close this one probably at the end of 2025, or I can leave it running. I don't really mind, guys. It's really up to you at this point. I did this for you guys to do the experiment because a lot of people say, well, buy the undervalued stocks, trim the winners, trim the big winners, and put them into the losers. And as we can see, so far in the last 6 months, that has not been a very good proposition to do. Moving back into the actual portfolio right now. So let me just reset them real quick. And let's move on because some of these spreads sometimes are a bit weird. So give me a quick second. All right, so just refreshing. Now we got the page together. So now the spreads are cooperating. So if you'll see, there was a few new wheel trades. Apple, 222.5 short puts that I fired off yesterday. That is just buying the dip on Apple, coming into oversold territory. If we come down to my strike price, it will be daily oversold. It will also be the 200-day moving average, and I'll be looking for a little bit of a bounce. So that is why I took the Apple trade. I took it yesterday, arguably at some of the lows of the day, and so far the position is moving decently. 113 is our average cost on those written puts, 0.5% rule for next Friday, and they're down about 50% profitable right now. The AMD leap is still in order. These bull call debit spreads, we bought these guys in like September. So it's been a while. They've also been worthless for a while as AMD has done nothing but sold off. So we are down on this position overall, but we've made so much money in the interim that one loss is not really going to offset the portfolio. I've kept these here for a long time at this point, but this once again is a trade, another loss, and I always show my losses, guys, and this is one of them. But you got to keep your losses small. You can see the size of this position, right? It's not as if I went in with 3, 4, 5 grand. But I am going to be building a little bit more of a position on these leaps if AMD drops a little bit more. Moving on further, we have AMD short put opportunity here, 115 put for January 31st, the week of earnings. I got about $1.89, which is not too bad for it, considering that. And we are now profitable by about 50%. If AMD bounces a little bit more this week, I will close these at a very hefty profit. Not looking to hold these into expiry. I'm just looking to play a bounce. And we got them when AMD was a significant amount lower than now. Well, not significant, but down here is arguably when we wrote them the other day. And we went with the 115 pretty much. So they are not doing too bad at all. Moving in. This is just an ASML dividend. It's like $4, so nothing to see there. Elf Beauty, 115 puts. I keep telling you guys I love Elf Beauty, so now I put my money where my mouth is. 115 short puts I got yesterday for 64 cents. 0.5% rule for next Friday. This is a decent margin of safety for Elf. Would put us right down into where I want the stock. And as you can see today, they had a decline. They were almost worthless, guys. These contracts this morning were like 20 cents, 25 cents. I told all my Discord members, I said, if you guys want to close, you can definitely close. The profit is there. But if you want to hold and maybe be assigned and actually get the shares, you can hold this contract. I'm taking the chance. I don't mind being assigned on Elf Beauty at 115. It's actually where I want the stock. So we'll see what happens with those. Moving on further, guys, the EVVTY swing shares. I still love this company. It's still very cheap, but it has not been moving well. Headline risk for some of the SIN stocks is one of the biggest concerns. Regulatory risks, fines, lawsuits, et cetera, et cetera. But you got to focus on the quality of the company, right? Tremendous, tremendous, tremendous net margins in excess of Visa and MasterCard. Very high profitable company. Fantastic fundamentals in terms of the balance sheet. No debt to speak of whatsoever. It is all free cash flow and cash on hand, looking quite good. And in terms of the future expectations for the company, well, I mean, the EPS graph speaks for itself and the revenue graph speaks for itself as well. And the analyst price targets as well are largely all above the current share price. So I like this one. My average cost is literally here. 82 in the context of where we are, good support level, good fundamentals, I'll hold. Moving in, Intel, this is just a leap call position that I bought a few months ago at this point, looking for the recovery trade. And into it, a bull call debit spread today, April 17th, 620 to 630 got filled today, 635 as a matter of fact. This is a new position into it, just a swing trade from the lows to the highs. So support range here, looking to swing it all the way up there. So we'll see what happens. I gave myself a lot of time up there. So, you know, bull call debit spread 620, 630, a lot of time on these contracts. We'll see what happens. Coca-Cola, same thing. I've had these calls on now for a few months. They're good till May. We'll see what happens, but Coca-Cola is looking good for some recovery. K-Web, this is an asymmetric bet. What do I mean by asymmetric bet? You buy it cheap and you're going for the absolute moonshot. So this is the recovery of China story. It may take some time, but time I do have. K-Web, January 15, 2027, $40 calls. We still have the Microsoft call debit spreads for the expansion of Microsoft. They're still currently one's at a loss, one's at a profit or break even. We'll see how those go. Micron asymmetric bet for performance in 2025 and 2026. We got these in September, guys. We've been riding them for a while. NVIDIA short put, long dated short put, 140s for $6.11. Slightly underwater, but I'm fine. Break even on these is 134. I don't mind buying shares at 134, guys. SOFI, we have this position. It's still covered. Oxy, my one and only oil play. We will see if the trend in oil can continue into March and make these contracts profitable once again. These were also purchased back in like September, October. It's been a long time we've been in those. SOXL, my call is still covered. I'll keep them covered for a little bit more time. This one is expired worthless today, so that one gets removed from the portfolio tomorrow. TLT, still have a bit of a hedge here, but I will maybe be adding to some January 2026 contracts there, maybe TMF. TSLA, this one also gets removed from the portfolio. Uber, I covered that earlier. That's our assigned position with a break even of around $63, as I showed you guys right there, right? The Uber, $63. 42 cents is the average cost on those. So we're actually up on the position overall. No complaints there. Waste management, call debit spread, 210, 220 for April. We are now up about 25% on those. Waste management, very easy trade for value. Really just a your support area trade. Looking for the expansion back to the higher end of the resistance range, 215, 220. We'll probably close these as a whole. And then lastly, that's pretty much it, guys. The last one is, what are these? Oh, this is Square. I don't know why it says XYZ, but it's Square. Square, still with some covered calls. They're largely all but worthless. And we'll be looking to hold these squares because we have a lot of time on them looking for the January expansion. And this one just gets called away as well. This one is worthless today. That's the TSLL 20.43s. So everything, guys, not looking too bad. That's the big rundown of the portfolio. That is everything for today's video. If you enjoyed that, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Would love to have you here. Almost 5K subscribers, guys. But I need your help to get me up to 5K. We're very close. Thank you very much for helping me out for that, guys. It's been a very big pleasure doing these videos for you guys, and no plan to stop anytime soon. And if you have any questions, always feel free to leave them down below in the comments section. I will get to all of your questions over the weekend, of course. And lastly, if you want to join the private trading group, my private Discord, where I share all of these trades in real time. These are all the trades since the inception of the Discord. You can see them. The green check marks are the wins. The red little things here are the losses. So that is all the trades since the inception of the Discord. If you're interested in getting all those trades in real time, link is always down below. Private morning live streams Monday to Friday for about 2 hours a piece. And you can ask me all your questions in real time in the live streams or in the chat Monday through Friday in real time. And I'll have a pleasure to answer you. So if that interests you, link is down below. And if not, see you back here, guys. Take care. See you over the weekend, and peace.